Come to our investment workshop or panel discussion tonight here at the Ambassadors. But before we get into that, let us just open with a word of prayer. So Lord, we thank you for the opportunity to share about investments tonight. We crave your presence tonight. We ask for wisdom, knowledge, and understanding. We pray that as the information goes forth, it will fall on fertile ground in our hearts, that the information will find good soil and take root and germinate. We pray that you will bring change in the way we handle our money, and ultimately, Lord, you will be glorified. So we offer up praise, we offer up worship, and we honor your name. In Jesus' name, amen.
Amen.
So good night and welcome to our audience in-house and to those who may be watching us online. Tonight here at the Ambassadors, we're having a panel discussion on investing in this economy, which is part of TLC's Blessed Life Sermon series. So tonight we're going to learn how to make money a blessing rather than a curse. So we've assembled a qualified panel. You guys are qualified, right? Who will help us with the area of investing and talking about investments. So on my right, we have the Thorpes. We have Krystle and Alwaine from Totally Thorpe.
Hello.
Hi.
And on my left, we have the McDonalds, Renate and Jermaine from Learn, Grow, and Invest.
Good night.
Hello.
For me, it's very heartwarming to see young couples working in ministry and handling their finances. And I've interacted with these couples on several occasions, and I can assure you, they are the real deal. So I'm going to have them introduce themselves, say something about themselves. So let's start with the Thorpes. Tell us a little about yourself.
All right, good night, family. We're happy to be here. We thank you for considering us, for being qualified. I'm Alwaine Thorpe, and this is my wife, Krystle Thorpe. And we actually have our show on YouTube, Totally Thorpe. So check it out, subscribe, watch a video them, all of them something. We are both professionals in the financial services. Krystle is an executive financial advisor. I'm a manager, unit manager at Sagicor. And we talk money on a daily basis. So that's us.
Okay, great. Thanks for that. Over to the McDonald's. Who is going to do the introduction?
Okay, so my husband says I'm to do it. So here we are. I'm Renate McDonald. This is Jermaine McDonald, my husband of 13 years on Sunday.
Yay!
Hey. Yes, so we are financial coaches. We would have shared here 2 weeks ago about on the topic of debt or debt workshop, but we have a YouTube channel and a community called Learn, Grow, Invest, from which we share and promote financial education and literacy. That is our core, and we have Learn, Grow, Invest Limited, the business that comes out of that community.
Good job.
Yeah, great job. I mean, they make my job easier. So we'll be asking our panel some questions, and we're hoping to drill down on this whole investment thing. So consider me not knowing anything about investment. So my questions basically are for my learning and for our audience as well. So let me start with the first question. When did you first learn about investing?
All right, so I'll start.
I see you pull the mic to your face, so clearly you're on the floor.
Yeah, so let's probably start with a definition of investing. So investing is pretty much putting money down with the expectation of capital appreciation or income. So when we purchase our home, we are expecting it to grow in value. That's what we call capital appreciation. Or if we maybe buy an investment property and we get rental income, then that's cash flow or income, right? So there are two reasons why we invest. That's pretty much the definition of it. So I just wanted to frame that. We started investing maybe 6 or 7 years ago. So it actually was introduced to Renate through a friend at work. When she first mentioned it to me, I was not interested. I was like, that sounds too good to be true. And the investment that she heard about at the time, it's actually, within the span of about 8 months, it grew 10 times, right? So it was at a price of $30. In about 6 months, it was about $300. And this was actually US dollars we were talking about. So it grew significantly. And at that point, I was interested. So we ended up making that investment at about $450. And, you know, that's not a happy ending, though, to that story, right? So the same investment we made went to $900. And I was like, you know, should we sell? She's like, no, let's go. We're going all the way. That investment later lost 95% of its value. So that was a great lesson, but it didn't turn us away from investing. It actually caused us to want to learn more about it, know when to buy, when to sell, you know, how to learn. So, I mean, that's a big reason why we started Learn, Grow, Invest.
Boy, that is no easy task to watch it happen, but baptism by fire, I would imagine.
Exactly.
You learn about investing. So for you guys, why is investing so important?
Because the Bible says so.
Okay.
So when I was in university, that was the first time I learned about investing. I think it was Rich Dad, Poor Dad that I read. And then, you know, getting more into the Word and into money. You want to find out what the Bible says about money. And when it comes to investing, it's a huge part of growing wealth. And I said, the first thing, you have to get money, so you have to work. Then you have to keep the money, so you have to save. And you have to grow the money, so you have to invest. And I think it's Matthew 25, verse 27, where the master, Jesus was talking about the master, pretty much telling the servant who didn't grow the money,
Right.
that he should have at least put the money with the bankers.
Right.
And grow the money. So that there you see Jesus talking about investing.
Right.
So it's important to invest because at the end of the day, we don't want to work all our lives. And you have to grow money in order to live comfortably in the latter years when you slow down. I'm not say stop working, but you slow down.
Yes.
Kind of like my period right in my life now. Okay.
And can I pick up on from
yes.
that?
Yes. Go ahead.
Okay, so there are two things about money, right? One, right, it's either you're going to have to work for it or your money going to have to work for you,
Right.
right? And to survive, nobody wants to be working forever.
Right.
So it's either you're going to be the one working forever or you're going to put your money to work.
Right.
So you have to choose, right? And everybody will put up their hand to say, you know what? I prefer I send that money to work.
Right.
And the only way you can guarantee that money bringing back interest for you is by investing
Right.
and having that long-term goal and that long-term plan and living comfortably and ensuring that your money is being multiplied is by investing. So that is why it's important to invest.
Awesome. Awesome. So tell me, at what stage of your financial journey should one start to invest? Assuming they've never invested and they don't know when to start.
Okay, understand. All right, so there should be a chart coming up now. It's called the Financial Planning Pyramid. Great. Okay, so this is a pyramid that we use every single day. Once we're speaking to someone about their finances, if they come to us and they want guidance on to how to start. So many persons leave university, whether you just leave university or whether you've started your first job and you have no clue where to start, this is what we guide you through. So it's a financial planning pyramid, so we start at the foundation. And the foundation of anything, guys, you're building anything at all, if you're building a house, the foundation is the most important part of that structure. And if
Agreed.
the foundation is sturdy enough, anything can come, it can't blow it down. And so it's the same thing for financial planning. The foundation is very important. So as you look there, you'll see life insurance, critical illness insurance, health insurance, debt reduction, emergency fund, regular savings, and will. That's your foundation. Mind you, not everything you may have in place all at once before you start to go to the next level. If you realize the next level now is where investment starts, which is the wealth accumulation level. And at that level now, you decide that, okay, I have set a foundation for myself. I have reduced some of my debt, because you can't just start investing and having a whole lot of debt. If you realize the debt reduction is at the foundation, it's like you're canceling out your money if you're going to be paying off this debt while investing. It makes sense to kind of just clear your debts,
Okay.
right? And then you now move, once you would have cleared that, then you use that money now to invest. So the wealth accumulation, you realize that it has all the investments, unit trusts, segregated funds, equity securities, bonds, and all of those things. That is when your foundation would have set, and now you can start double into investing.
Okay. So you're saying handle your debt issue at the foundation.
Exactly.
Get that out of the way.
Get that
necessary.
out of the, get
And
that
then
out
you
of the way.
start to build on that, which
Right.
is your investments.
Or get it under control.
Get under control. Okay.
Right? Because you do have investments that may be giving you much more than you're paying on the interest for your loan. So if it's a situation where say you have student loan, because for me personally, when I had my student loan, I was doing a little investing, right? But my aim was to get rid of the student loan as quickly as possible, so that chunk of the money that I'm giving to SLB, I could turn that over and put it into investment.
Right.
And I realized that it turned over way faster if I cleared my loan first
Right.
and then use that money to invest.
Right.
Yeah, man. What I want to add there is that reason why you see the foundation there, and if you realize how sturdy the foundation is that when you have a building and the foundation is there and you start to go up and you build your house on the rock, when the breeze comes, the hurricane comes, something happens,
Yes.
you have your emergency fund.
Right.
That is at the base. If God forbid you get a critical illness, you have the critical illness insurance, you have a health insurance to help.
Okay.
At the base.
Okay.
So you don't have to close your investments to go take care of yourself. You have the foundation
Right.
there.
Right.
Can I just say something
Sure.
on this? That pyramid there is a lot of confirmation for us, right? Because the truth is, we learned, as you heard earlier, about investing through experience. So we didn't get a lot of the theory and the formal training and thing. I tell people all the time that I feel like the Lord literally held our hand and said, this is how we're going to move. You're going to clear the debts. You're going to do A, B, C, and then you continue growing. And so that's how we learned. So seeing it in the
Yeah.
theoretical form is like,
Yeah.
oh, it's a thing. You know what I mean?
Yes.
It's something you kind of know,
Yeah.
but
Yeah.
seeing it in that way really cements it for me as
Yeah.
well.
So I'll add something here. So that I mean, we shared our story before. I don't think we need to go into it again. But so we were greatly in debt, and before we knew that we wanted to get out of debt. So one of the things we realized, it was just important to get control of our money. So a lot of persons don't want to start investing because they don't think that they can afford it. It doesn't take a lot to get started, right? And we'll talk about that later on, I guess, but just understand and have this mindset that you don't need a lot of money. Investing is not for the rich, it is for everyone.
Yes.
There are different ways to invest, and we'll get into the ways later on, but I just wanted to share that before we go forward.
Awesome. So tell me, what are the different types of investment options that are available to persons?
I guess I'll go with that.
Yeah, you can go ahead.
All right, so you have the traditional stuff that everybody hears about.
Right.
The stocks, the bonds, the real estate funds, the real estate itself.
Right.
You have different vehicles and instruments that institutions offer that investing all of these things for you.
Right.
So yeah, I think Siobhan mentioned it when he spoke.
On savings.
Yeah, on savings, where he used an instrument that we offer to help him to buy his house.
Okay.
That 10-year plan.
Okay.
And it's one of those things that makes sense for you, especially if you aren't disciplined to automate.
Yes.
Yeah, to automate that. So that helps to get there. One thing that I always try to put into the investment talk is investing in your own business.
In their own business. Okay.
And that is big, because I think it's Ecclesiastes 5 verse 3 says, a dream cometh through a multitude of business.
Okay.
So I interpret that and say, all right, I need to invest in some sort of business. And investing in your own business is a really great way of growing wealth.
Right.
And when you look at stocks, what are stocks? Investing in businesses.
Right.
So if you say, all right, I don't have the aptitude, I don't have that, business prowess, I'm going to invest through stocks in other businesses. So those are some ways to invest. And then, of course, all the creative ways to invest come somewhere in that.
Okay. Okay.
Yeah.
I'd like to add to that as well.
Yes.
Just going back to what you said about real estate.
Right.
A lot of persons nowadays, they love the word real estate and they want to invest in real estate because, of course, it's booming, right? It's that thing that everybody wants to have. The reality is that it's hard. The upfront cost is a lot, right? So you have to save for it, or you have to even invest some money. You start small. As Jermaine was saying, that you can start small. You can see something that you want to invest in, like a home, a property, whether it be for your personal living or you want to invest it and have somebody, a tenant, to rent it out. But what you want to do is to plan your strategy and give yourself time to build to that place where you can build up your deposit. So it's a big investment, but you need time to get to that place where you can use that money now to do that additional investment, right? So first and foremost, you have to give yourself time, be patient, have your goal, set your time frame. It is 5 years. Don't be afraid to put some proper time on, realistic time on it.
Okay.
Realistic time. Always be realistic, because at the end of the day, you earn a certain amount, but you have to put yourself in the position to say, okay, I'm not able to do it in 2 years. I may be able to do it in 5 years, but you have your timeline. And you say, okay, this is what I'm going to do every month. And as Alwaine mentioned, automation is key, guys, because don't trust yourself to say you're going to do it. If you look how much time we say we're going to the gym, and we don't go to the gym. So we can't trust ourselves to just say, okay, we're going to invest, and I'm putting on my foot this month, I'm going to be doing it. No, automation works. And I'm saying that because it's the same for me, right? It's the same for Alwaine. We put certain things in place that it comes out of your account before it even hits, or it comes out of your pay before it even hits your account. Or even if you're going to do it as a standing order, ensure that it comes out as the pay hits the account. So get it out of your hands, right? So you have that time. You have the time to put it aside and get to the bigger goal of purchasing a home for personal or even investment purposes.
Awesome.
So we're talking about investment options, right? So usually what we teach persons is that the investment option that you choose should be based on the goal that you have. So every goal that we have has some financial component. There's no goal I can think of that doesn't have an element of money. It could be that the money is zero, right? But so you set the goal first, and then from the goal, you look to see which investment vehicle can get you to that goal in the best way according to your tolerance for risk, right? Because every form of investment has risk. So that's the way that we recommend that persons do it. Now, for those who have goals that are, for example, let's say that you have a goal to go back to school, then we say, okay, based on that goal, we first start with our disposable income. So if my disposable income allows me to get to that goal by saving $10,000 per month, for example, and I can get to the goal in 10 months, then I may not need to invest to get to that goal. I can just save and I get there.
Yeah.
But let's say that the goal is in 6 months. Let's say it's October now and I want to go back to school September next year. Then I have a goal that's 11 months. So I can say, no, based on my salary, based on how much I know that I have, if it's gonna cost me more than I'm able to save, then I can look at my options. I can now invest towards that goal, and then should I have a gap, maybe I can seek some sort of financing option, right? So that's kind of the way that I think about it first. In terms of your options, the lowest barrier to entry that we see in terms of investing is the stock market. But there are other forms of investing, as we said. So it's really about learning what your options are first. Each option will have a rate of return, some sort of risk, a learning curve to it. And then you use that to determine, based on your preferences, which path to take. It doesn't mean that you only take one path. It just means that you take the one that is suited for you. Now, if you tell me you work in real estate, I would tell you to invest in real estate because you have an added advantage. If you tell me that you work at a bank, then maybe I'd tell you that you have access to maybe their investment department. You can get information that maybe the rest of us can't get. So, well, Renee said no. I mean, just there could be a relationship then between that bank's investment house that you may be able to speak to somebody right. in a informal way that can help you learn faster. Is that okay? Okay. So that's kind of the idea, but there are lots of investment options. What we do personally, we choose the stock market first because it's easy to learn. And then from the stock market, we now invest in other things, right?
So you're investing in companies, but not necessarily starting the business yourself. You're buying into the business.
Right.
Okay.
And we use the proceeds from that to invest in other things, like the real estate or like our own business, etc. Okay.
So I'm now jumping to my next question, and you touched on some of it, is what are some of the products that are available to invest in? And you mentioned the stock market.
Yeah. So there are a couple ways to do it, and I'm sure the Thorpes will add to this as well. So if you're starting with the stock market, which we recommend, but there are other things that we'll mention. Of course, there are two ways to think about it. You can go the route of picking your own investments.
Eeny style or?
No. So we actually have content on our YouTube channel that will help you learn what to look for before you invest.
Okay.
Right. We host free classes every quarter that you can attend to learn about the stock market.
Okay.
Essentially, though, what the stock market is, you're purchasing ownership in publicly listed companies, right? So we each work at or have worked at a company. The company has customers, products, services, it makes money, and based on how well the company does, the stock price will move accordingly, right? That's a very simplified version of explaining it. But let's say that you start there. So you can now have the option as well to speak to a licensed financial advisor who may have no products like a unit trust or an equity fund. We don't really have mutual funds or ETFs in Jamaica, but it's a similar thing where all the fund is a group of companies or a pool of companies in one fund. So let's say that we had Company A, Company B, Company C in one fund. We put a price on that fund and you purchase units of that fund. So it gives you what we call Diversification, it spreads your risk. And then it allows you to get exposure. So, pension funds do this. Some sort of other types of funds may do that to just purchase the funds, and so they have a kind of broad exposure to the market. I would say start there if your capital is low. Now, if you have a certain amount of capital and you're willing to take on different types of investments, and we mentioned it before, you have companies that you can look at, you have businesses that you can start, there's investing in the US market, there are a whole bunch of stuff that we may not want to burden you with right now, but just understand that there are lots of things to invest in, lots of ways to invest in them. So it really starts with seeking that information first, and then you learn what works best for you.
Yeah, man. And then, of course, each institution, financial institution, usually they have products. So insurance companies have products that are tied to investment in some way, shape, or form. Investment banks have products. And the group, them pretty it up, pretty much. A lot of the products are usually tied to like the unit trust and pool funds. So some people, they don't fully understand, them just know the big title, equity, that's stocks. You have bonds, like global bonds and stuff, that's bond market, that's debt market. You have real estate, I want to put some money in that. And then what I say to people all the time too is that if there's a quote-unquote sector that you like, real estate sector, there are some real estate companies on the market that you can actually buy into if you really want to get into it that way too. Yeah.
All right. You throw some words, some of them I catch, some of them I don't understand. But can somebody here on the panel define stocks very simplistically? I mean, I might know, but some in our audience and some online might not know. What is stocks? What are bonds? And what is a mutual fund? You say we don't have that in Jamaica, really. We have like unit trust.
Yeah.
So can you just very...
All right, so I like simple things, right? So I'll make it simple.
Me too.
I'll make it simple. So a stock is really a share of the company, right? Meaning, a company when it's publicly listed or it's going to the stock market, right? They are giving you the opportunity, or they give the opportunity to buy a piece of their company. So you will hear when a company is going on the market, which is called an IPO, initial public offer, you'll hear 20% of the company is being made available to the general public, etc. It means that whatever their company is valued, overall, 20% of that is being made available for you to buy. And then you can purchase it, and once you purchase it, you legally own a piece of that company.
Okay.
So whatever amount you spend to purchase that stock, that is equivalent to the percentage of the company that you now own.
Okay.
Which is why I tell people, if you own the stock, buy the things. Like,
buy the things and support
buy the things what they make.
that you're a piece of.
Support your own business.
It's now yours.
Can that make sense?
Buy the products that they sell. Buy the companies that you believe in and that you understand their business model, how they make money, etc. Because at the end of the day, when you are supporting that company and when you are pushing that company, you're pushing something that you own, right?
Mm-hmm. So you want to explain a bond as well? Or you want me to say that one? Okay.
Well, I need to know what a bond is.
So a bond is pretty much a loan, right? A company is going to give you a company needs to raise money. They can issue a bond at a certain interest rate. So when you purchase that bond, you get a particular amount of interest on the money that you've invested per quarter, per year, depending on how it is meant to be paid. Bonds are considered low risk but not risk free. And the same things that you'd expect to happen for a loan, right? We have had situations where companies have issued bonds and they've had challenges, right? So that's why I say low risk but not risk free. We spoke about the funds as well. I mentioned it before. Everything that says the word fund, whether equity fund, mutual fund, unit trust, some institutions have some fancy name for it. Capital growth, growth fund, Sigma, accumulator. They're all the same thing. Well, they're all similar. They'll probably not be happy with me saying they're all the same thing. But they're similar in that they represent underlying investments. It's very, very important to understand what that fund is made up of, because if you don't have a tolerance for real estate and you buy something called a real estate fund, that is going to be invested in real estate. So it's important to understand. What I like to do is ask for the details of the fund and the performance for the last 5 years. And I'm taking the last 5 years because sometimes you'll see companies market and say, or 2018 results were 400%. And then I say, okay, it's 2022. What happened for the last 6 months? Well, it's, we're in a challenging time. It's minus 10%. So you want to pay attention to the last 5 years. What I do is I take out the outliers. So if 1 year it was negative 30 and then 1 year it was 400, I take out those two values. And if it does on average 15%, 20%, then that's what I know I can expect for the next 3 to 5 years. It may go really well and do another 300, 400%, or it may do poorly and do a minus 30.
Okay.
But at least I have now a sober view or expectation of what I can get from that fund. And that's how I'd recommend that you look at those.
Okay. Renate touched on the fact that if you buy stocks, you really should be thinking about stocks in companies that you believe in. And if you buy the stock, you really should be supporting the product behind that company that you're buying in. But how does one know what type of stock to buy? I mean, because there's so many companies out there. How do I know what stock to buy? What am I looking for?
So you're looking for companies that have a track record of performance, right? So our stock market in Jamaica is split in two markets. You have the main market. Those are the companies that are a little bit more mature. Then you have the junior market. Those are considered the companies that are just starting. And just starting doesn't mean that they opened last year. It just means that they're smaller, meaning their revenues may be $1 billion or less. The
what?
main...
What?
1 billion.
$1 billion or less.
$1 billion or less.
All right, we need to talk after.
Right? Those are just the revenues. That's different from profits.
That's the JSC's
Very
definition
different.
of small, not ours.
Okay.
So junior market companies usually have a cap of raising 500 million, right? So in terms of what companies to look for, as we say, start with companies that you know, right? All of us eat food. They're food companies. We understand the things that impact food. So for example, if it's a rainy season, maybe persons, the supermarkets are going to be cleaned out. We may expect that food companies may have a good quarter while we're having the rainy season here in Jamaica. We know that, let's say that a year or two ago, you had companies that were, had the potential to bring the vaccine to Jamaica. So they're in that industry, pharmaceutical or medicine. Maybe you want to look at those companies depending on what's happening around you, right? So I would say start with Warren Buffett says this thing called your circle of competence.
Okay.
Just start with what you know.
Start with what you know.
Start with what you know. If you don't know anything at all, then I would say start with the things that you're likely to understand. Meaning, most of us understand retail. You have companies like a Fontana, for example, that's in retail, they have a pharmacy, you understand that business model. Retail is essentially, we have goods, people come in, they buy it, we do a small markup, but we sell volume, things like that, right? So once you are able to select some companies, you want to now understand how have they been performing over the past few years. Again, you want to look at the history. Now, there's this thing that is said where the historical performance doesn't determine future success, but it's good to understand where they're coming from to understand their potential.
Okay. All right.
And I would also add to that is watch their content and learn how to read financials, because it's very important if you're going to actually really figure out how to invest in stocks. I like to say revenue is vanity, profit is sanity. So you'll hear about $1 billion revenue, and then you look, the profits aren't really there. And just understand that it's the profits that are going to share up and pay you.
And not the revenue.
And not the revenue.
Okay.
Revenue eat up into the business.
Okay.
To grow the
I'll
business.
just add here before we move on. The reason why we advocate for persons to learn it, let's say you use a financial advisor and they make a recommendation, and you ask them why did they make that recommendation, and they explain it to you. You need to be able to understand their explanation. Right? So we're not saying go and do it on your own if that's not what you want to do. The parable said the least you could have done is giving it to the bankers, meaning the very least have somebody manage it for you, but you want to be able to understand what they're saying, right?
Okay. All right. So what would be let's say I hear you talking about portfolio, and I would imagine portfolio is what you have, right?
Yes.
Your stuff. So what would you say is the right amount of stock to have in your portfolio? Because there are other things that you can have in your portfolio. So how much stock should I be investing in?
That sounds like me again.
I can answer.
Okay.
All right, so while it varies, right, and there are various theories about it, and different people will tell you different things. Our recommendation, especially if you're just starting, is not to go more than 5 stocks, right?
Stocks.
5. If you're doing individual stocks, don't try to do more than 5. Why? Because trying to monitor more than that becomes a full-time job. You want to be able to manage. You want to be able to know the state of your flux, right? Mm-hmm. Proverbs 27, guys, read it. You want to know what it is that you have, how the companies are doing, etc. If it is that you overwhelm yourself with all of these 20 companies to be following up on, imagine trying to follow all the news on 20 companies, reading all of the financial reports when they come out, their annual reports, the quarterly reports, going to the AGMs, all of that for 20 companies, it's quite a lot. So we recommend start with like 5. And we believe that concentration, which is having less, right? Having less companies, focusing on less companies, that concentration is what builds wealth. Diversification, when you have a lot, you have your money spread out, that's when you're maintaining wealth. That's when you don't have the money. You're already wealthy, and you're saying, all right, let me preserve it in all of these different areas. Try to have less, build the wealth, and then you can move from there.
Awesome.
If you think about it, most billionaires that we know, their wealth is concentrated in maybe a few investments.
Yeah.
So if you name a billionaire now, there's likely one thing that you know him for. That's what we mean by concentration. So it's just easier to manage, as Renate said. The alternative to that, we normally say to persons, if you absolutely cannot manage to track and manage your own portfolio, find the best performing fund, and then you can invest in that. And the idea is that the best performing fund should at the very least beat inflation.
Okay.
Yeah. And then there are also some professionals that say you should never invest more than 40% of your net worth in any one asset class.
Okay.
So,
Stick up in. So I have my portfolio.
yeah.
Of that, some is stocks and some is something else. So what you're talking about portfolio class now.
All right.
You're talking about
So the asset
the
class, you look
different
at
I want to
the
explain
different
those.
types of
Yeah,
things.
explain those
Yeah, man.
terms as well.
All right. So when you talk about the asset class, you look at the equities. You look
It
at
is
the,
with stocks,
yeah. You look at the debt,
debt, okay.
and of course you look at real estate.
Right.
Of course, in a situation like with business, the reality is, like what they said, what Renate just said, is that when you're building wealth, chances are you're heavily focused on one asset class. But in order to spread the risk, what they're saying is that if you are worth $1 million, they are recommending that no more than $400,000 should be invested in any one of those classes, because if something happened to that one,
It carries on everything.
exactly.
Okay. See what you're saying. I see what you're saying. All right. So how can I measure? Let's say I'm new to this whole investment thing. I don't know whether I'm a heavy hitter, if I have a risk appetite. How do I measure what I can handle?
Okay, so one of the first things we have to do a portfolio review with you. And when we do a review, we'll ask you certain questions to kind of pull out from you to see where you fall, whether you're a low risk taker, you're moderate, or you're aggressive in your appetite. Because at the end of the day, you can want 100% on your money. You want to earn 100% on your money, but you are a low risk taker. You always hear the term that says, no risk, no returns, right? Or high risk, the higher the risk, the higher the rewards. And that is real for investing. If you're not taking any risk, chances are your returns will be low. And it will be lower than somebody who is taking higher risk. And it's the same is true for persons who are taking higher risks. They can lose much more than you. So when we sit with you, we go through, ask you the different questions. Based on your answers, that's when we categorize you and put you in a category to say, okay, you're more low risk, you're more moderate in your risk taking, and you're more aggressive based on those things, based on your appetite to take in the risk.
Yeah.
So we have to do that.
Amen. As regulated, regulators have mandated financial institutions to measure the risk appetite of each investor that comes in. So it's really looking at what amount of loss can you tolerate.
Yes.
None.
So you're
Then
low
you're low
risk
risk.
then. You're low risk.
None. I want
low
to
risk.
double my money,
It don't work that
Without
way.
the risk,
but I don't
I'm
want to
sorry.
lose no money.
It
Without
don't
the
work
risk.
that way.
Yeah, man.
It don't
Oh.
work that
So-
way.
You see, it's things
Don't work
like
that
that why Ponzi scheme work, you know. So there is no legitimate investment that
That is
has
risk-free.
zero risk.
Exactly.
Every single one comes with some sort of risk. It might be low, but there is risk.
Yes.
So I was gonna say to that question about the type of risk that you can take. I want persons to understand that a lot of us don't take risk because of fear.
Yes.
So we don't want to invest because we're afraid, we don't understand, we may lose it all. Remember what the parable said, each was given according to his ability. If we learn the basics, then we can have enough knowledge to build wealth according to our ability, right? So I say that to mean that risk, I may have a really high risk tolerance, but I'm married with a son and a mortgage. I may not have the benefit to be aggressive with my investments. So sometimes our circumstances will dictate our risk tolerance.
Okay.
Right, so I just wanted to add that. So when the older you get, the more security focused you may be, meaning it's the stakes are higher. So it could be that the stakes are high, so you don't want to take a certain type of risk, and that's okay. So remember, we spoke about that foundation. Once you have your emergency fund, you have certain things in place, take some risk, because you're not going to be able to build wealth without risk. Even running your own business is a risk. And the risk is that nobody would buy your goods for the next 6 months. Like, there's just always some type of risk, right? So like, anything can happen. So don't invest because you don't want to lose any money. Invest a certain amount. I will not say do not invest what you can't afford to lose. I do not believe in that saying. I would say just invest wisely and understand and appreciate that there is some risk.
Okay. All right. So you mentioned, yeah, I need the prayers. You mentioned that you're able to classify whether this person in front of you that you're talking to is a low-risk person, middle, high-risk person. Is there investments for each of these risk persons, the level of risk that you can take?
Definitely. And as Jermaine was saying, it's also about probably your age, what's your goal, what's your reason for investing, how soon you want this money. Right? So all of those things we have to look at before we give you or recommend a product to you. Right? So because we have to give you the right product. Right. We can't give you something that we know that will not turn. You say you want this money in 5 years. We can't give you something that will turn in 10 years.
Right.
You don't have the time.
Right.
If you're at age 50, moving into your 55, closer to retirement, we can't give you something that's high risk. We can't play with your money like that. Mm-hmm. So when you come in, the questions that we ask, your purpose for investing, your goal, your target, all of those things we have to pull from you in order to give you the best product.
Okay. It's important to understand that your goal, again, as I said before, determines how you invest. So if somebody says, 52 years old, I want to retire at 60, what do I invest in? Then that's going to determine the recommendation, right? Because that you have a very set timeline. Now, sometimes we'll discuss with persons and we'll say, well, maybe the timeline is a little bit aggressive. Mm-hmm. Maybe you want to work a little bit longer. 5 more years could mean the difference for you. And there's sometimes we find that there are persons who are in a better position than they realize.
Okay.
Meanings like it could be that the mortgage is almost done, they fully paid off their car, children are already out, but maybe they're in a big house. So they're in a 4-bedroom house, it's just them. Maybe you want to downgrade that house so that you have the capital to retire when 60 comes. Mm-hmm. Right? So it's all about your specific situation that determines how you should approach it.
And one last thing I'll add to that is that usually with the investment products, Pastor Paul, you asked if there are different types of investments for each category, and usually with the brokerage houses, what they do is categorize the investment type. So they'll tell you, this is a low to medium risk investment. This is low risk, this is high risk, this is medium risk. They'll tell you the rating of their products. So if it is that you're speaking with a broker and you don't get that information, ask them for it.
Okay. Yeah. Okay, well, I need hand-holding. There's no two ways about it. I want much, but I don't want to lose none.
Can't work.
Okay. All right. So what percentage of my income should I put towards investment? Is there a number that you're working with? Let's say I get X dollars. How much percent out of that should I be putting towards investment?
Well, you want to go ahead?
Yeah, man. Well, our recommendation is usually anywhere between 10 to 20%.
10 to 20% of what my income is, I should be investing.
Yeah, so that's our recommendation. Some people are able to do more, and some people might not be able to get there as yet, but can work towards there, but start somewhere. For example, if we sell a pension product, recommendation is a minimum. If you realize lifestyle kind of heavy, at minimum 5%, and let us like try and rearrange some things to get you to the 10, to the 15, to the 20. Okay. But then you do have some people who live way below their means and are earning well enough to invest more than that. So at the end of the day, it's based on your reality, but at the end of the day, you need to set certain goals, and that minimum goal should be 10%.
Okay.
So I would say invest everything that you can invest. And the reason why I say that is, think about it this way. Imagine you being able to pay for your vacation, pay for your back to school expenses with profits from investing. Right? So once you've covered the foundation again, the foundation is extremely important. Invest as much as you can. Invest as broadly as you can, because what you do, so the more you invest, the faster you can get to your goals, right?
Yes.
So if somebody has 60% of their income available, I wouldn't say 5%. I would say invest 60% of your income, because you can always now choose how that is spread out. It could be in
60%,
something.
but it could be low risk for some and high for us.
Exactly. And
Okay.
so the reason why I say that is once you keep it in the bank, you're losing purchasing power. So, I mean, once you're doing your budget, all of your funds should be allocated, first of all. So once all of it is allocated, whatever is left, I think you should invest, at least until you get to a certain point now where you're comfortable with where you are financially.
Okay. All right, let us say I stick out my head and I say, okay, I'm going to invest that money. What if I look on that money over time and I see I'm losing money? Tell me, what do I do at that point?
Okay,
I mean,
I
I
guess I'm
follow your
taking it.
advice. I follow your advice. I put money on the table. You give me some guidance, and I watch it every day, and it's going down. What do I do?
So first, we want to just be clear that you
Don't watch it every day. Don't watch it every day.
Jermaine said don't
Okay.
watch it every day. I agree, don't watch it every day. But in addition to that, you really don't lose until you sell. So if you have purchased a stock or an investment and you log on, you're looking on your online platform and you're seeing less than what you put in there, on paper you've lost the money, but you don't actually lose any value until you choose to sell.
Well,
right?
Well, actually, you lose value, but you still own the asset.
Right, but I mean,
You haven't
you
realized
haven't
the
realized the loss,
Yeah.
right?
Okay.
You haven't realized the loss, right? So that is one. The second thing is, this is another reason why it's important to understand what you're investing in. Because some things are seasonal, right? Which means that they'll do very well now and they won't do so well 3 months later, but it will come back up and they'll do well again. There are some times that companies are going through changes. They might be going through some restructuring, etc., and that impacts the stock price. Or there's something going on in the fund that is impacting the price. You need to understand why it has dipped before you do anything at all. Because the why is what is going to inform your decision, right? Do I accept the loss and actually sell this asset so that, just call it sunken cost. It's fine, I lost the money, I accept that and I move on. Or is it a situation where you expect that there will be a rebound, that it will come back?
Yeah.
So you just hold strain. You just hold on and wait until it comes back up, right? And and this is why we say that everything has risk, right? So there's nobody who can tell you definitively that it must come back up, or it will, or it won't, or it will never come back up, you know? Nobody can definitively tell you that. But again, it's going back to using the past performance to predict as best as possible what is coming next.
So I'll use 2 examples to answer this question. If you live in your house, let me ask you, Pastor Paul,
Right.
the house that you're living in right now, if you bought it at 10 million and then you found out that the value is 8 million, would you sell it?
No, I just go outside, go repair what need to repair, and paint it up, and it look crisp. Then me sell it for 20 million. No,
But the idea is that
I'm just joking. Yeah.
you still
I
own
know
the
it
house.
has. I would know that it has value.
Exactly.
Because I did my research, bought the house, realized that this is a good house, even though the market says it's valueless.
There you go. Right? So that's the first example. The second one is, let me use now the example of a car. So let's say that you have a car and Jamaica does not like the Mazda brand, right? So let's say that you own a Mazda. It's now valued at 1 million. You get a valuation, the valuation say 800,000. You know that 6 months from now, that's going to be valued probably like 750 or 500, right? So in that case, you would say, well, let me just sell it now, because if I don't sell it now, in a few months' time, it's going to be worth less and less and less, right?
Yeah.
So in that case, it may make sense. So as Renate said, it comes back to what it is you own. There are some investments that the likelihood of it going back up, depending on the season, is high. In that case, it may make sense to just do some more research and hold tight, but other things may just be going down and down because some persons are afraid to take a 10% loss. A 10% loss is easier than a 50% loss.
True.
So sometimes it's easier to take a small loss and you use those funds to invest in something else than to hold and say, you know, I'm gonna hold on forever. It's the market that determines the price of the things that we own. Just like it's a market that tells you that I'm not gonna pay you more than 8 million because your valuation says 8 million for that house. And it's the market that's gonna determine that since it's a Mazda, I'm not paying you more than a certain amount for that Mazda.
Okay. Alwaine, same thing. I'm losing money. Me talk to you. You tell me this is a sure shot this.
Pastor Krystle.
I want to pick up on that because persons tend to pull out, or what I have observed is that persons tend to pull out their investments when they're desperate, right? When they see it falling, they're desperate to pull this money because they need this money. And I'm going all the way back to the top when I spoke about having certain things in place before you start investing. You will put this money down and you know you can't afford to have this money in the account, or you can't afford to have this money in the investment for a year or two. Why put it there? And you didn't have an emergency fund. You didn't have a regular savings. Investment, I tell persons time and time again, investment should be your last resort. When I say last resort, it should be the last thing that you think about pulling out, right? You should have gone to taking out your save, whatever it is. Any emergency comes up, exhaust every other option before your investment. So what I find is that people tend to pull out because they're desperate. You can't afford to wait. You can't afford for it to go back up. And history has taught us that more than likely, if you see the stock was going good for 5 whole years and something come up and you see it dipping, chances are it will go back up. But you need patience. And if you don't have that, and if you don't have the luxury of patience because you need this money today and you need this money for an emergency, then you're going to pull out, and that's when you lose.
So the base and the foundation of that pyramid is extremely important in a situation like that, because it now gives you confidence
to wait,
and it allows you to take some more risks.
So I would have taken care of all the base, the foundation, my will, my this, put on savings, put on money in reserve.
Emergency.
And then, as I step up,
Yes.
Then I can, I actually like that pyramid significantly, and I think I will put a mirror in my bathroom. So,
Yeah, man,
So I
it
can
makes
look on
sense,
it.
man. It makes sense.
It makes sense, for sure.
all right, let me put a scenario to you. Let us say that I came into some money, a sizable sum of money. I got a bonus check or I got a significant raise in pay, but I'm clueless as to what to do with this money that I never expected. It's outside of the norm of what I would normally have. What would you advise me to do, or somebody in that position, coming into some money that they never expected, bonus check, or you get a significant increase of pay? Your boss just like you and think that you've been around for a long time and you deserve this money. What do I do?
So I can share what we do as an example. So there's no right way. I mean, the first thing that we do is tithe. And then we have an agreement that if it's a lump sum, the person who gets the lump sum, so after we tithe, 50% of that balance is invested, and the remainder is for the person to choose what they do.
We should do that.
As a couple. Okay, sounds good. Sounds good.
Okay. Alwaine, you remember telling me about when you got your first bonus at work?
Some bonus, man.
Tragedy.
I
Real life scenarios we're talking here now.
I remember getting my first bonus, and I said, all right, this is before the church, by the way.
Right.
Yeah, man, so I remember jumping in my car, drive go Ochi, check one friend, and then look at the time. Oh, I have time and rush come back in and run go a club, buy 3 bottles of champagne.
Okay.
And I'm like, yeah, man, I have money. And when I went home and I looked at it, and I said, boy, I never spent half a whole lot, thankfully.
Right.
But I looked on it and I said, boy, I could have done so much better. And I mean, I remember when Krystle and I got together, and I was just looking at the situation that I was in financially at that time, and I look at it and I said, what am I doing with money? And I think about those things. So when you come into a lump sum of money, the first thing you need to do is to sit down and plan.
Yes.
So what I do when I come into a large sum of money, and Krystle, you remember this in recent times, first thing, tithe.
Yes.
And then what I put this rule in this house, that if it's a large sum of money, we don't tithe 10% of it, we tithe 20%.
Okay. If it's a large sum.
If a large sum is 20%.
20%.
Right.
And you just come, boom, 20%. And then the rest is now divided out. So we had mentioned that we're going to, a percentage of it goes to debt reduction, a percentage of it goes to investing in the stock market, a percentage of it goes to investing in our business, and then what we do is that whoever get the lump sum,
I get my portion, or he gets his portion.
whoever get the lump sum get to spend that a percentage. It's not 50% though. But
No, definitely not.
it's less than 50%. I think we should increase ours to 50%.
No, I don't think so. I don't think so.
I mean, the reason why I think we do that is Renate will tell you that I watch the numbers closely.
Same. I'm the
I
CFO.
can tell you everything that we've spent on food for maybe the last 3 years.
You're serious,
Right?
man?
Serious. So for me, when it comes, it should feel like a reward for being disciplined. Right? Because we don't budget for a bonus. We should be able to live with whatever we earn, which is why it's important to stay within our means.
Right.
So when the bonus comes, if it's mine, I'll likely invest all of it. But if it's Renee's, I want her to feel like, no, she's free to maybe do something that she was not able to do because the budget is managed so tightly.
Right.
If it is that you're in debt and you get a lump sum,
First thing, yeah.
yeah,
Yes,
it may
of
make
course.
sense to clear the debt, right? It's all about, again, your specific situation and what is most pressing to address.
So what I've been hearing so far, debt reduction has to be dealt with
Has to.
because
Definitely.
it can carry down.
Right.
We saw the pyramid and we saw that reducing debt is in your foundation. So what we would advise persons who are listening today is deal with the debt and what you would use to pay down debt or bring your debt down significantly. Once the debt is off the table or significantly managed, then you can think of putting that same money to better use elsewhere.
Yeah.
Matter of fact, I want to just point something out. Reducing debt is a form of investment. A lot of people don't see it as that, because what's happening is that you borrow $100,000 and you're paying, for example, 20% on that per year, right? Instead of paying this 20%, then we pay down on the principal and reduce the amount of interest that I'm paying. So they say $1 saved is $1 earned. So if you're saving on interest that you don't have to pay out, you have earned that money back.
Yes.
Because instead of paying the bank $20,000 this year, because I pay $50,000 on it, I only pay the bank $10,000. So I've saved $10,000.
Right.
That frees me up $10,000 future money, $10,000 in the future money. I can put that to work in the future.
Right.
So paying down on your debt is a genuine form of investment.
So there's this thing that we teach our coaching group is the total cost of ownership. And it can actually work for your investments as well. But let's focus on expenses, right? So when you seek to acquire an asset, you want to think about the total cost of ownership. So with your home, it's not just the mortgage, it's the maintenance, it's the property tax, it's the insurance. With your car, it's not just the payment, it's the
Insurance and fitness.
it's the insurance,
and all those.
registration, fitness.
Yes, everything.
Exactly. So if you look at the total cost of ownership we like to do it for 5 years. So if you do it for 5 years, then you really understand what you're paying for the thing that you have purchased. And that gives you an idea of how much it really costs to own it. So if you're not comfortable, a $3 million car paid for over 6 years could cost you $5+ million, plus 5 years of maintenance, 5 years of gas, 5 years of fitness, 5 years of replacing tires, etc. You may spend not 5 million, but maybe 7.5 million in just 5 years to own that vehicle. So think about it. What could I do with that 7.5 million if I just maybe bought a car cash for $1.5 million or $2 million? I'd save 5.5 million over 5 years. So just think about it that way, and you'll find that you have more cash to invest.
And I'll just say from a real perspective, like a real emotional perspective, we often buy things because of how they make us feel, right?
Yeah, man, are cute.
Yeah.
No, man,
Yeah.
cute. Cute is
Yeah.
the investment thing. Cute.
Or it brings some sort of validity or validation to us. And it brings to the fore the importance of us not putting our value or getting our validation from the things that we own. So what Jermaine just mentioned about buying a car cash for 1.5 instead of maybe taking a car off the lot, right? That is, for a lot of us, a matter of pride that we have to deal with. Like,
We're speaking from personal experience. We both went through it where we wanted to be the first persons to own the car, kind of thing.
Yes.
But that feeling will go, I guarantee you. And you'll wish that you can sell that car immediately.
There's an example,
Right.
right? No, after you finish, I want to mention it.
Yeah, so I'm just saying that when you look at the numbers, sometimes it helps to sober you up. I remember 2 weeks ago when we did our debt session, one of our attendees said it was the first time that she was actually writing down her debts and looking at it and facing it, and it was a sobering moment for her. And it's the same when we're dealing with our investments and choosing to make some changes in our lives to be able to deal with the debt and deal with the investments.
Yeah, man, and to what you just mentioned, a friend of mine, we were talking about a new car, looking at a new car, and then I said to him, I would never buy that. And he asked why. and I said, there's a man right now that just bought the brand new Range Rover that's trying to sell it. But he's trying to sell it for the amount that him owe. When I was looking for my car, and I realized that the vehicle was selling for a certain amount, and I'm like, this don't make no sense. Mm. And I asked the guy, he's like, them have to pay back them loan. I'm like, oh, that's why. It's because you take out a 10-year loan, and matter of fact, as much as 12 years now, for some vehicles, a 12-year loan on a vehicle, and you cannot sell that car after.
To pay back the bank loan.
No, sir. The Millionaire Next Door, that's a book that I recommend for everybody. It speaks about the value of a vehicle. And the typical millionaire buys a car that's 2 to 3 years old because the significant loss of value has gone. Right? So the most appreciation that a vehicle experiences in the first 3 years.
Right.
So if the total cost in a situation like that, you're buying a car for $5 million and you get a 10-year or 12-year, guess what? You are literally paying more than double the cost of that car over the lifetime. So when I say,
but it's cute.
They can cute all it want, but your bank account not cute after your bank.
Agreed.
The reason why we're stressing debt, and it may come back to debt, is the more money you have available is the more you can invest.
Yes,
right?
exactly.
That's kind of where we're going here.
Yeah.
Mike?
One thing I want to share as well is that don't raise your standard of living because your income has increased. Right. And so many of us do that. We get the increase, we get the raise, and we say, no man, new car, no, ooh, what kind of Honda, no, Audi. You know what I mean? So you find that a lot of times, all of us do it. We see the little raise on our pay and we start to think big. We don't think about, okay, can this extra money that I'm getting, can it go towards investing? Can I put it on something that will work for me? No, we tend to do things that will not benefit us in the long run. So once your income has raised, because you had asked a question, Pastor Paul, if you get a raise on your pay, what do you do? And our advice is that invest it. Don't raise your standard of living because it has increased.
So a very simple way that we raise our standard of living is in what we eat.
Yes.
So we may have said, okay, it's patty and cocoa bread and juice, but now we get $20,000 more. Is BK or is KFC?
Which KFC? They're going up to one of those fancy restaurants.
I'm just speaking just from
Max Steakhouse.
I mean, I say that because as simple as it sounds, our food bill can get ridiculously high.
Yes.
So food actually eats out a lot of our wealth because it just costs a lot, right?
Yep.
So I just want to, it is ridiculous. And that is a very big area of, not that it's cute, but that you see the area where the checkout counter is.
Yeah,
I like to just
chocolate,
stand by my
peanut,
wife
nuts.
as she walks through that little section there because you'll have $10,000 of items in your cart, and in the last 5 minutes of shopping, you double that total.
Oh Lord. Sure.
Because you're in the line and it's oh, and then it just kind of.
And one thing you should never do is to go to the supermarket hungry. Trust me, promise me, don't do it.
You spend more
Every
than you need
single
to.
thing looks good.
Okay, awesome. All right, let us say now that we're at the stage where we've invested properly and we have made wise money decisions. And how do we preserve this asset to pass this on to our generation? How do we do that? We've done all the right things. We've saved, the foundation is set, we've made good investment decisions. How do we preserve this asset for our children?
So if you go and look at the pyramid actually has wheels as a part of the foundation.
And what your will does, your will, not because you do a will, you're going dead. People are...
So
A
me-
lot of people believe that actually, a lot of people are afraid to do a will.
Don't start me on those.
Yeah.
I have stories about that.
What a will does, it makes the transfer of your assets easier. If you don't have a will in place, what happens is the courts decide who gets your assets. The courts decide who decides or who administers your assets. And in a will, you do that. And if I don't want this person to get this much, I want to give them this. A will says that. Now, what a lot of people don't understand is that a will has to be funded. What I mean by that, if you have invested and you grow your asset base to $50 million, for argument's sake, that includes your house, or maybe it's $80 million because you've got another investment property and you have some stocks and it's going well, and you, God forbid, die. By the way, this is a certainty. It will happen. And you die. In order to transfer that $80 million of assets, your heirs may have to pay anywhere between 15 to 20% of the value of your assets to pass that on.
So you have the asset.
Yeah.
But they have to put some money down to get that asset.
Yeah, because you have to pay the executor, that's the person who administering, you have to pay the lawyer, and you have to pay the government. And every single one of them want their money. Right? And what tends to happen is that, all right, I'm going to have to sell something to keep some things. So estate planning is a serious thing that a lot of people don't consider, right? When you have your will, it makes it easier. That remove the government from your business, that take them out of your business, right? But you have to have it funded. So we always recommend getting some life insurance
To
cover that liquidity, that necessary liquidity that will be needed for your beneficiary to get those assets transferred to them. You will never build this wealth for it to just fizzle out and die out. You build this wealth so that you could create generational prosperity. And it's not political, by the way.
Right.
So generational wealth is a serious thing. So you want to ensure that you are building the wealth and then protecting the wealth at the top.
It's solid advice. And roundabout now, I've come to the end of my questions for the panel, but we have room for taking some questions from the audience, and we also, I believe some persons have put some questions online questions.
Yes.
So let us, if there's anybody in the house who wants to ask a question, we're going to be taking 2 questions, and then we go to online, and then we can always come back in-house. So if anybody has a burning question that we have not covered, and now is the time to take.
What I was going to say, maybe we take online while persons are coming up.
Yeah, I can read one.
I'm looking at Norris, but I don't want to call on Norris suddenly. But Norris, think about your question before you come up, eh?
So the first question I'm seeing online is that, are there any books you recommend that dumbs down the whole investment process for those people who need the hand-holding?
Rich Dad, Poor Dad is one. It has some controversial
Yes, it does.
things in there, but
I used to give that book as a wedding gift, you know.
Yeah?
Yeah. For years, I used to give a book, Rich Dad, Poor Dad.
What it does, though, it helps to shift the mindset.
Right.
And I think that part of the book is good. Money and Marriage God's Way is something that we read and listened to, because I'm a listener. And there's another one, I'm not investing. There's another, I think Ron Blue writes that. Total Money Makeover by Dave Ramsey. That's a good one. The last 3 books I just mentioned, that's 2 books. I never mentioned one. It's Christian authors.
Okay.
Those books help to kind of put certain things into perspective. As far as knowledge of money, one that really shifted my mindset I mentioned earlier was The Millionaire Next Door.
Yeah, man. Very good book.
Yeah.
I read that book.
So for me, our whole investment philosophy is actually based off the Bible.
Yes.
So I stopped reading. So I went through a phase where I was reading all these books on building wealth. And I was like, a lot of these things sound similar to what the word says.
Right.
So I stopped reading all those books and just said, I'm going to read the Bible to get as much as I can about building wealth, managing money. And then when I feel like I'm at a certain point where I'm living all those principles, then I'll go back to
Okay.
the external
sense.
books. So I'd say start with the Bible.
See what the Bible has to
Proverbs,
say.
Ecclesiastes, very good books to start with.
Awesome. So we took a question online. I see some persons who have positioned themselves to ask some questions. So let me turn it over to now I send somebody to deputize. So go ahead.
Good evening, everyone.
Good evening.
Good evening.
Yes, Norris did send me. All right, so hypothetically speaking, say I am a newbie investor and I have dealt with my foundation wealth pyramid as shown by Alwaine and Krystle. And I'm now at the point where I'm planning towards investment. However, with recent media reports from media houses such as Fortune, Forbes, and Bloomberg, I believe, which project that there'll be a recession hitting the US by the end of this year, and it's projected that it will last for the entirety of 2023. What's your perspective on the projected recession, and what's your advice for the newbie investor who is looking to plan towards investment in using this going forward?
Jermaine, you want to go first?
You said that the recession is expected for the 2023.
No, for 2022. So
2022.
yeah, the economists and persons within the financial industry, they have been doing projections based on the current inflation rates and also the current conflict in Ukraine.
Russia. Yeah, Ukraine
right,
and Russia.
and how the world powers and it's affecting each economy, which will eventually affect the world. So
Yeah.
they project that the US, it will start in the US and then eventually affect the entire world in towards the latter part of 2020.
I kind of picking your brain a bit to say, did they give a time that
No,
they expect that this would last? What?
So it's always a moving timeline.
Yes.
So I've been hearing about a recession for maybe the last year and a half, 2 years.
Yeah.
Right. So even
And some argue that it's already here.
yeah.
So-
Yeah. A lot of people say it's already here.
So it's really a moving target. So I understand the question though, how do you invest in the midst of economic uncertainty, right? A recession has technically happened based on the definition of a recession in the US already, right? Two economic quarters of decline. They've had that, but they're not calling it a recession due to other things that haven't really lent itself to what normally happens in a recession, right? So all of that said, should it happen in the US, the expectation is it will start to have like this ripple effect throughout the rest of the world, right? So a few things that I would say, again, that's why your foundation is important, right? I would say you can plan for the recession looking at your personal finances first, right? So even before you touch on investing, are you in a field that's likely to be impacted in a recession? Are you earning enough to comfortably cover your expenses? If there should be a shock and you lose your income for 6 months, where would that bring you? And what I started to do is actually try to recession-proof my career from about 2 years ago. So I've been trying to focus on skill sets that will lend itself to, if there is a recession, if my company sends me home, I have plan B, C, D, right? So that's the first thing, because you can't invest from, well, you only invest from excess, right? Nobody's gonna invest as a baseline kind of thing, right? So that's where I'd start. Try to secure your personal income and finances as best as you can. After you've done that, you really want to invest normally, is what I would say. Meaning, do your research, invest regularly, because you can't predict when. If you, let's say you don't invest because you're expecting a recession, and then a year from now we're still waiting on the recession, you would have lost 1 year in terms of an opportunity to invest. But let's say you are investing and January 1st comes, you know, everything goes south, then you would say, okay, I have money saved, I'm in a secure job, maybe I'll just now curb some expenditures, save a little bit more cash, wait until prices get to a certain point, and then I just, again, invest normally.
I was just thinking a while ago as you're talking, that if the stocks of good companies dip, that would probably be if
There
you
you
have
go.
all your base
Exactly.
covered, it would be probably a good time to pick up
Very
some
cool.
stocks.
So wealth is made in recessions, you know.
Yeah.
Wealth is made in
Definitely.
recessions.
Yeah,
Right,
man.
right.
So with the foundation in place, the emergency fund, which is 3 to 6 times your monthly expenses, for people who are in business and on commission, we recommend 6 to 12 months of your expenses in an emergency fund. And the reason for that is, especially in a situation where the recession is here, I like to draw on Warren Buffett's quote where he says, be fearful when everyone is greedy, and be greedy when everyone is fearful. And the reason for that is good companies, with Jermaine saying you invest normally, and you're investing in good companies. These are recession-proof companies, and when you look at the financials, they're cashy, because a recession hurts the people who don't have cash first, right? So that's why that emergency fund on the individual part is so important.
Yeah.
And then when those companies, the price of those companies go down because everybody's selling off them stocks because they don't have an emergency fund in place, you do. And you can now have some money, so you're saying, all right, I'm going to buy this at a discount because I'm pretty sure this
That is
company
it's gonna
that
come
have
back
a
up.
whole heap of cash going to last through this recession. So my advice is to build up your emergency fund, work on that foundation, and look for good companies to buy.
Awesome.
We'll take one, I think we'll take one more.
Norris's protege has stepped up to the mic, so let us hear the question. Hi, Jackie. How are you?
I'm good, Pastor. Good evening, everyone.
Good evening.
So my risk is like,
I see
can't
that
see
hand.
that. I know,
I
I
see
can't
that
see-
hand.
I
It's
can't
very
see that.
small.
I
Yeah.
can't see that at all.
but I'm listening to the wisdom and I'm a little concerned. So in the 90s, I purchased some stocks, and because of my risk level, when it soared, I sold enough to make back what I spent. And I have not looked back at it again. Meaning
You're
I-
probably a millionaire right now.
Right?
I just forget about it.
Oh, you sold it.
No.
She only sold her
sold
principal.
enough.
I
Take back
sold
out her
enough to
principal.
make back what I
Okay, you
spent.
took back out what you put in.
Yeah, she put in $10, she take it back out.
Okay.
Once
Yes.
it gone up.
And I have not looked back at it. So I'm wondering, I bought some again. We bought some again, babe.
No.
I don't want to make that same mistake. I'm hearing now that I need to monitor. And I would love some guidance as what do I do? Do I just go back online and look at the value, or what exactly do I do to monitor? And with someone with such a low risk, I think I need to have 5. I would love some guidance as to like the best ones to try at this point. But remember the risk level.
If you have extremely low risk,
Extremely.
which it sounds like yes,
Extremely.
find the best performing fund
Unit
and
trust.
buy some each month.
Yeah. If you're doing individual stock, that's not going to be a
Yeah.
low risk level.
Yeah.
It's not going to be. But in terms of monitoring the stock that you own now, yes, you can go online and do it. You can do it at jamstockx.com. That's the Jamaica Stock Exchange website. It allows you, they allow you, using JTrader Pro, that's their platform, they allow you to get all the information that you need about all the stocks, all of the historic information, etc. So you can find out how the stock has performed over time. You can find out what it is doing now, all of the news that is coming out about the company, all of that stuff is there on the Jamaica Stock Exchange website.
Were those dividend yielding stocks? Have you been getting your dividend checks? Okay,
That's
so
good.
fill out a dividend mandate so that those checks go straight to your bank account.
No, not to the bank account, to the, what you call it, the investment house? Not to the bank account, to the investment house. So it doesn't come in,
You do get it.
it's not
Okay.
easily
Okay.
accessed.
Oh, so it's reinvest. So as
No,
it
yeah,
comes,
you probably
No,
in a
it's
cash
just
account.
there.
just in a cash account.
You probably in a cash account there.
All right, we have to go talk to you, Jackie. We'll talk.
Yes, we'll talk offline, Jack.
Yeah.
Yeah, and-
but, but,
Appreciate it.
but I would suggest that they run quarterly. You run quarterly investment,
Classes, yeah, free
Classes, free classes.
Free.
and you know them. All right, so you can talk, and you know Alwaine and Krystle as well. So you can have a talk with them.
There's one online that I saw earlier. It's actually a very long one, but the essence of it is that they're out of the country and they want to invest. Dual citizen living in Jamaica. That's as a U.S. citizen living in a foreign country. So she lives here.
Yeah, it sounds
Yeah.
like Renate, if you have the question, just yeah.
Clarification. Yes. Right.
gonna say-
I was clarifying up here because I'm familiar.
So she is of both Jamaican and US citizenship, and she says, while living in Jamaica, there's a significant restriction on what it is that she can invest in because of the taxation that that is
Capital
applied to
gains
her
tax and
as a US
IRS,
citizen.
blame the
So
IRS.
she's just asking for a recommendation on how she can build wealth. This is her home. Yeah? As a dual citizen.
Or when my clients see that, because it's a fat cup, they have to fill it out, because what happens is that the states, they want to keep track of their citizen and their citizens' taxable income. So to be completely honest, I don't know how the paying of the taxes based on what you earn goes, but you can't get around the tax situation. You have to pay your taxes. Your strategy for investing needs to be surrounding making enough money to beat the inflation and grow to the rate that you want to. So my suggestion would be pay attention to the content on YouTube that Learn, Grow, Invest have, and speak to a trained and licensed professional. Let them know what your goal is and what's really going on, what you really want to that you need to make more money than you are paying out to your government,
Right.
and be guided by that.
Okay.
So I would just add to that, it all depends on what kind of laws are governing that sort of state. Because the laws determine what the best ways to invest, right? So you need to understand what you are allowed to do or not do, and then let that guide your investment decision. Now, if it is that the US is only concerned about your US-based investments, then I would probably focus my time investing in Jamaica since you're here. If it is that all of your investments are taxed a certain way, regardless of where they are, then as Alwaine said, it's just about earning enough to compensate for what your costs are and be guided by that. But I'm sure that there will be opportunities for you to still build wealth. You just need to understand the rules that are governing your status.
And the state that they live in the States.
Yeah.
Speak to a tax accountant or a tax
Yeah, that's what
attorney.
I mean by understanding, because you have to speak to somebody who understands both to be able to guide you in the right way, because I'm definitely no expert on taxation.
Especially US.
So I wouldn't be able to guide there.
I just know that there are a lot of tax loopholes that if you understand it and you speak to the correct tax professionals in that jurisdiction, you can definitely benefit. There are some people who only choose certain types of investment just because they
Exactly.
understand
Yeah.
their tax jurisdiction.
Yeah.
Okay.
Right,
We
so,
have
yeah, I think Peter was.
we have Peter and then we have David.
Yeah.
Go ahead, Peter.
Hi. This is not a question, though, but this is to add to the discussion on the recession. It is always said that, as you have said, that when you buy stocks, when they're going down, people are... But remember, Ecclesiastes 3 says there's a time for everything. Mm-hmm. So when you buy it when it's going down, it will go up. Mm-hmm. And then you will make a killing of those.
Mm-hmm.
Yeah.
And there's also a scripture that says, I think, if you wait for it to rain or something like
If
that.
you watch the rain,
You'll never
Yes.
invest, right?
There you go.
Yeah.
And that was the next thing, that if you always think that it's going to go down, it's going to be hard times, you will never invest.
Okay.
So that was just my comment.
Yeah.
man.
Thanks.
All right, thanks for that. David?
Since the issue was mentioned about U.S. taxation, I am a dual citizen, and what I do know is that as an individual, the U.S. will tax you if your income here in Jamaica is above 80,000 U.S. As a couple, if it's above 120,000 U.S., then the U.S. will also tax you on it. If not, it's what the Jamaican government taxes you on if it's below that, if the income
Okay, great.
is below that.
80,000 US as a household.
80,000 US as an individual and
Oh,
120,000 US as a
household.
household.
Oh, okay.
If your income is above that, 80,000 or 120, then you would also be liable for US taxes. If not, it's just what the Jamaican government taxes you on.
Okay.
Okay, perfect.
But my question is, for somebody who is a moderate risk taker, in terms of digital currency and investing in that digital currency market, what would you recommend as a percentage of your portfolio?
That is you, you know. We anticipated your question before you came up. So I turn you over
Yeah,
to
man.
Jermaine.
So I would say if you're moderate, so I'm giving this recommendation based on the moderateness of your risk profile, right? I would say somewhere around 5% of your total investments. And the reason why I say that is that's actually industry recommendation, right? They usually say you can have cryptocurrencies be 5% your total portfolio. That means if it does really well, then great. If it does poorly, you only lose 5% of your net worth. So I'd
Yeah,
start
and
there.
the thing to consider about cryptocurrency is that it is still very volatile, right? It's very new, it's still unregulated, and so a tweet can send a currency skyrocketing, or it can send it plummeting, and it won't come back up for months, years. So
If ever.
because of the volatility of cryptocurrency and digital currency in general, it is recommended that it's a small portion of your portfolio. Whether if you're a lower risk, moderate is 5, and that's fine. The lower risk, 1% good. You know what I mean? So and truthfully, that 1% can do a lot if it is that the currency is doing well. But the same rules apply in terms of taking the time to research and understand what you're buying, because there are some currencies that are really just jokes. There are some currencies that have no value. There's nothing to substantiate why it goes up or goes down. And if it is that you're buying into something like that, then there's no way you can predict what's going to happen with it. Yeah. There are usually white papers that are written for these currencies. Read them. If you don't understand it, nobody buy it.
And I just say that, so what we do in terms of cryptocurrencies, we focus on investing in ones that have utility, meaning there is some real world problem that it's solving, and that increases the chance of it having a longevity to it, right? So I know this is not a question, but while we're waiting for the next person to come up, I'll just say that in our country, we may have certain schemes that are shrouded as investments. I just wanted to say that. There are a lot of persons who do not invest now because they were introduced to Cash Plus as an investment. That is not what we're referring to here. I have to. I have to. And the reason why that is that we hear about them all the time.
Yes.
You have things that are not based on anything. There is no product or service. It's just a shifting of the risk until it all falls down.
Agree.
I mean,
right?
like that whole put in 5,000 and you get 25,000.
Yeah, man.
Yes.
Yeah, man.
Anything like that does not point to something tangible,
Yes.
it is not an investment.
Yes. Agreed.
I see online there are...
Let's just take this
Okay.
question
Yes.
and then we go on.
All right.
All right, good evening, everyone.
Hi.
So my question is, for persons who have life insurance policy, normally they recommend that there is an investment portion.
Come closer to the mic. Yeah.
Many of us don't know about what is being invested in or anything like that. What would be your recommendation if somebody have an investment portion to their life insurance policy? Should they take it out and put it somewhere else, or just let it remain there?
Okay, so for the life insurance policies that I sell, the investment component, actually, there are several funds you can invest in. So this now will all depends on your agent, your advisor that you sit with. Some persons will just say, okay, if you're paying $10,000, $5,000 goes towards the insurance, $5,000 goes towards the investment component, and they just put that money there, but they don't tell you. They may have just stick the company split, which would be a compilation of all the different funds. What I do, I will sit with you, and I'll say, here's what. These are the funds that are available for you to choose from. But then again, I have to ask you the questions to figure out what is your risk appetite. And from that, I will put that savings component into the different investment that suits you based on your risk appetite. So it doesn't just go flat like as a bank. It actually goes into funds that will give you interest.
So to the other part of your question, no, you don't need to take the money out. What we would say is to keep that investment and invest otherwise as well. So it's not either or, it's both and.
So you want to know what's in the investment first, though, because that determines what you do. If that form of investment is not able to get you to your goal, then you may want to have, as Renate said, something to supplement it. I mean, since it is an investment portion, you usually should be able to get a statement to tell you what the cash surrender value is or some value of it. You want to examine that. But I would say, so usually, from my understanding, I may be wrong here, but if you're paying, let's say, for example, $5,000 on that policy, and $1,000 out of that $5,000 goes to investments, just bear in mind that if it's such a small portion, it's not going to lead to anything significant down the line.
Yeah,
so the
correct.
portion that you're investing is important. So that should guide your decision as well.
Yeah, man. So what I tell my clients all the time is that the money that you're putting in this investment, you can do two things. You can make it go and grow. Well, it end up being three because people always touch it from time to time. But you make it go and grow and leave it there, or you allow it to grow to the point that you need it to grow, take that money off and do something with it. Because at the end of the day, you do have some investments that are capital intensive. Property is one. So for example, Krystle and I, when we were buying our house, we were able to take money off of one of our policies and have that help us to invest in real estate, right? I was watching a business conference today, and they spoke about the cash value on your life insurance, using that to help you to start a business. Those are things that you can do with that money. So it's dependent on your goal and what you want. So again, I always say, don't let it be the only place you're investing, but you should be investing there as well.
And I'll just quickly add to that, the same goes for your pension. Your pension fund, guys, make sure that you understand where the investment, what it is that the fund is investing in, how it is that they're investing the money, and monitor that as well when you get your annual statements. Where have they invested and how is that performing for your pension? Because at the end of your working life, that is what you're expecting to draw on, right? And also supplement your pension because
Know the condition of your fund.
supplement your pension because it's not likely that your one income from that pension will be adequate to sustain your lifestyle upon retirement.
Especially if it's just 5% you put in. Especially if it's just 5% you put in. Remember, at retirement age, you're going to get what is there. And if you put a little bit of money, you're going to be getting a little bit of money.
All right. I understand that we have, I figure we have 10 more minutes. So we're going to go online and we're going to answer as much as we can cover in 10 minutes. So panelists, if we can just keep our responses short so that we can get through as many questions as possible. So you can.
All right, so I'm seeing one that says, can your risk appetite change over time? Yes, it can, and it usually does with age. And in the earlier stages, you can play a little bit more with the money because you have time to recover if you lose the money. In the later stages, you want to preserve as much, so you kind of reduce the risk appetite at that point. I'm seeing another question. What is our take on freelancing and owning an online business? I think that's very good.
Yeah, I can take that one. Freelancing, owning an online business, it's still owning a business. It is still an investment. It's an investment in you. The Lord has placed gifts and talents within you, and if He's called you to business, whether it's online or brick and mortar, do it. Pursue it. It is an investment as well, and not doing it is actually dishonoring the gift that you have.
Bearing your talent.
Yes, exactly.
Yeah.
Another one I'm seeing, it's asking, can you split your investments between low and high risk portfolios?
Yes, you can. You can do whatever you want to do with your investments. So, usually if you go into a broker, they'll actually, depending on your risk tolerance, give you a balanced sort of portfolio anyway. Anything that has the word balanced, diversified, or fund is usually a good spread of risk anyway. I would say if it is that you are heavily diversified, just understand that your room for growth is going to be capped based on how those funds usually operate.
So So I want to address one that I'm seeing. That's saying, I think I'm afraid to invest because I was duped into an insurance policy that did not actually have an investment portfolio.
Duped is the word they use?
Duped.
Okay.
I understand what they're saying.
Yeah, man. So, all right, speak to your advisor and ask the questions. When you ask the questions, you should get the answers. What happens is that a lot of people who we speak to, they don't understand what it is that we're giving them. Right. And if you ask the questions, you need to ask the questions. That's all I have to say. Ask the questions. As advisors, Krystle and I, we're going to tell you what it is. Even before you ask. But we welcome the questions because we want you to understand what it is that you're getting so you don't have buyer's remorse after, which is what tends to happen.
Yeah.
Some policies have life insurance and long-term investment tied to it. Some policies have short-term investment, short-term investment side tied to it. Some, it's very commingled. And then others, like coupon plans, they're just insurance and protection. So ask specifically about the type of plan and what it provides for you.
So I'll just throw in something there only because so for the public, and I actually see this online sometimes, there's a confusion between insurance and investment. Again, this is where understanding maybe our culture. There are some persons who refer to insurance as an investment. You want to understand the difference. If it's considered an investment, you want to ask for what is the expected return on investment.
Right.
If they can't tell you a return on investment, it's not an investment, right? So, knowing the right questions to ask, as I said, is extremely important. But in our culture, a lot of different things are called investments, and sometimes we may get something that does not serve the purpose for which we wanted because culturally it was called something else.
I think we can take maybe two more questions.
Two more.
So I'll address this quick one, right? Question is, what is the estimated fees advisors usually charge to assist with finding investment opportunities for us? And the quick answer is usually there's no charge. The brokers, when you go to a brokerage house, we have 15 licensed brokers in Jamaica. And when you go to a brokerage house and you open an account, usually you are assigned an advisor. And that advisor is at no cost to you. So they're at your disposal for you to ask all questions, for you to tell them what it is that you need. They do your assessment, your risk assessment, etc. They give you the advice. That's literally their job. That's what they're paid to do. You're not the one paying them. Their company is paying them to do so. If they're charging you, go get that checked out.
No. Well, if they're charging you, they're probably independent. So independent advisors will charge. A broker, an advisor assigned to a broker who works with a broker should not be charging you.
Yeah, correct. So you do have some people who charge a fee for that advice. On the insurance side of stuff, we don't charge. It's actually priced in. We paid based on commission, so it's based on results that we're paid.
Okay. All right, let's take one more question, and then after that, I'll ask our panelists to just let you know where you can find them. That was the last one? Okay. Well, let me just thank our panelists. We have the Jermaine and Renate, and we have Krystle and Alwaine, and I must say that I learned a lot tonight. Would you say that? And I'm just going to turn the floor over to our panelists, starting with the Thorpes, and just let us know where we can find you.
All right, well, Totally Thorpe, you can find us on Instagram at Totally Thorpe and on YouTube at Totally Thorpe. Please go like, subscribe, all them something. Thank you very much. On Instagram, Krystle's IG is Krys Thorpe, Krys Thorpe. My name is Alwaine Thorpe, and that's my handle, ALWAINETHORPE. I'm on Twitter too, but I don't really use it.
They come to TLC, so find them on TLC and call them and talk to them
We're there.
as well. Right.
So for us, learn, grow, invest on all platforms. Learn, grow, invest. Now, you can reach out to us and ask any questions. If the questions are simple enough where we're able to give you a response like most of what we took here tonight, then fine. In some cases, you may require more help. So we do offer one-on-one consultation. Or if you're a couple and you want to work with us as a couple, that's fine too. We do free investment classes every quarter on our YouTube channel. Free for you to attend, but it's typically intense, meaning we pack a whole lot of content in 3 hours, but we usually leave the videos up for 1 month. So if you miss the class, you have 1 month to watch the video, and then you just have to wait for the next quarter for the next class. All right, so once you search for Learn, Grow, Invest, you'll find us, send us a DM, and we'll be very responsive.
Or our website, learngrowinvestclub.com.
Awesome.
All right. And by the way, you can reach out to us when you go on social media if you have any interest in any form of insurance products or you want to review your portfolio. You can come to either of us and we will assist you. And that is free of charge.
One thing is for certain, we learned something tonight. So much so that when the Blessed Life series is over, I would love for us to do this periodically. And I'm inviting you again in some capacity for us to do this again, because this is just absolutely awesome. So I'm going to close in prayer. Lord, we just want to bless you for a great night. We've learned a lot about investing, and most of us would have been prompted by the Holy Spirit on our next moves going forward. I want to thank you for steering our conversations, and we ask you, Holy Spirit, to help us to assimilate what we have learned and to follow your guidance, and let us take charge of our money for the rest of the year and going forward. So as we go, Lord, we just ask you to cover us under your blood, protect us as we journey, and just be with us. We thank you, we bless you, and we give you honor. In Jesus' name we pray. Amen.
Amen.
So again, I just want to thank our panelists for sharing their knowledge and expertise with us. And I'm just asking you to support them and check them out on their YouTube sites and their platforms that they have out there. Have a great rest of your night, and let's see you in church on Sunday. Take care.